Ever wonder how some companies just, well, keep delivering, hitting those impressive results quarter after quarter? Today, we're pulling back the curtain on Roper Technologies. In this deep dive, we're going to unpack their latest Q2 earnings, look at the strategies, the innovations, and what it all might mean for you.
Exactly. Think of this as your fast track to understanding how a major player like Roper keeps that growth engine running. We'll look at their smart acquisitions, how they're using AI, really aiming to give you those practical takeaways, those aha moments.
Okay, let's dive right in then. The headline numbers, Roper just reported a really strong Q2 2025. They definitely beat what Wall Street was expecting.
Yeah, strong is the word.
Their earnings per share, EPS, that hit $4.87. The forecast was $4.83, so a nice beat there. And revenue came in at $1.94 billion, just ahead of the $1.93 billion expected. But importantly, it's a 13% jump in total revenue compared to last year.
Yep.
Pretty significant growth.
It is. And what's really key behind those numbers is the underlying strength. Roper keeps these really strong profit levels. We're talking a gross margin of nearly 69% over the last year.
Wow, 69%.
Yeah, that signals really efficient operations, valuable products, and the market. It definitely noticed. The stock saw a bump pre-market, about 1.19%, trading around $551. That shows clear investor confidence, right? And if you look broader, their overall financial health score is rated good, 2.61 out of 4. So strong fundamentals, solid foundation.
Okay, solid financials check. But what's really driving this, digging into their earnings call, something really jumped out at me. It's their big focus on AI-enabled products and these strategic acquisitions.
Yes, the AI story is fascinating.
It really is. CEO Neil Hun, he actually put a number on the internal impact. He said, we are definitively getting the internal productivity gains. 30% in one of our larger software businesses, 30% from AI. That sounds huge.
It is huge. And it shows AI isn't just talk for them, it's actually changing how they work. So how's it impacting them? Well, it's kind of a two-sided coin. First, internally, like Hun said, big productivity gains. Think customer support, go-to-market, even content creation. They're using it to, rethink the whole business, make it AI native.
AI native, okay.
And second, it's about the customer. They're using AI in their products to solve very specific problems their customers have. This isn't just tweaking things. It actually lets them sell into bigger markets, expanding their TAMs, their total addressable markets.
Right, so it's efficiency inside and new opportunities outside.
Exactly, optimizing the engine and finding new roads.
And they're actually building things, right? It's not just theoretical. They mentioned, about 25 AI-enabled products, either out already or in development. That's quite a pipeline.
It is a serious pipeline.
Okay.
And while the direct revenue from purely AI products today is, maybe tens of millions in ARR, annual recurring revenue, they see a bigger picture. They talk about a compounding effect, a positive halo. So maybe a customer comes for an AI tool, but then ends up buying more of their traditional software too. It lifts everything.
Ah, I see, like a gateway.
Sort of. And here's the really interesting part about their philosophy. That 30% productivity gain, their mantra, as they call it, is to reinvest that. Use it to do more, drive competitive advantage, boost top-line growth. They're not just letting it drop straight to profit right away.
That's different, playing the long game.
Absolutely. It's about building that durable advantage using AI, not just grabbing short-term profit. It's a strategic choice. Are you using AI just to cut costs now or build value for tomorrow?
That's a really key distinction. Makes you wonder how many companies are truly thinking that way.
It does. And it allows them flexibility, like with pricing. AI pricing is still, a work in process everywhere. There's no single answer. But Roper sees a trend emerging, a sort of subscription with consumption over the top, like a base fee, plus you pay for how much AI you actually use, keeps it scalable.
Okay, that makes sense. Flexible. Now, speaking of strategic moves, let's shift to acquisitions. Subsplash, that's the latest big one, right?
Yes, Subsplash.
Described as a leader in AI-enabled cloud software for faith-based organizations, churches. Seems quite specific.
It is specific, but don't underestimate the niche, the deal itself. $800 million purchase price. It's expected to bring in around $115 million in revenue, maybe $36 million in EBITDA, looking ahead to Q3 2026. And crucially, Subsplash is already growing fast on its own high teens organic growth.
High teens, wow.
And it just ticks all of Roper's boxes for acquisitions. Leader in a niche, competes on knowing the customer, strong margins, throws off lots of cash, it fits their blueprint perfectly.
So beyond fitting the mold, why this market? Faith-based organizations, what's the big opportunity there?
Well, the market size is pretty big, about $2.5 billion just in the US. But maybe only half of that is currently being surged by modern software, so lots of room to grow. And the really interesting thing is that these organizations are often, as Roper put it, super early in their modernization. Think about churches still using very manual processes for donations, communication,
Yeah,
management.
a huge potential digital transformation market.
Exactly. And Subsplash is seen as a second generation platform, meaning it's built on modern tech, well positioned to capture that shift. Plus, Roper sees a chance to significantly expand margins. They can bring their operational know-how, professionalize the business, optimize sales, R&D, payments, basically apply the Roper playbook.
So take a good company in a promising market and make it even better operationally.
Precisely. And then you get these powerful flywheel effects. Subsplash's tools, like digital giving or church apps, apparently lead to a 15% increase in donations for the churches using them.
15%, that's a direct impact.
Huge. And that proves the value, right? Which makes churches rely on the platform more and maybe adopt other Subsplash tools like church management software. It just feeds itself. More engagement, more donations, more tech adoption. It's a smart loop.
Okay, that makes a lot of sense.
Yeah.
Now, Roper mentioned growth was pretty balanced across their segments in Q2, which is good to see. But were there any particular standouts within those segments? Let's start with application software.
Yeah, definitely some highlights. Within application software, you had Adorant. They apparently had their biggest bookings quarter ever,
Ever, okay?
driven by AI tools for law firms, helping with things like document review, research, big efficiency gains. Plus, they're gaining market share and moving clients to the cloud. Deltek also saw strong cloud migration and embedded their AI assistant, Della, right into CostPoint.
Deltek and CostPoint. That ties into government contracting, right? There was talk about the big, beautiful bill.
Exactly. That bill could be a big catalyst for Deltek, though the timing is always a bit uncertain with government stuff. Then in network software, you've got DD in the freight world. They're doing really well, increasing the value they offer, raising the average revenue per user. Integrating trucker tools and Outgo helps there. Construct Connect is also moving ahead with its AI takeoff and estimating tool for construction bids.
Okay. And technology-enabled products.
Neptune is doing well with its ultrasonic water meters and the related data and software. Good execution there. So yeah, balanced growth, but definitely some strong performers within each segment.
It's good to hear the wins, but, business isn't always smooth sailing. Every company hits bumps. How Roper handles those, that tells you a lot, doesn't it?
It absolutely does, and they're quite open about it. Take ProCare, an acquisition from a while back. The initial performance was, let's say, mixed. It grew, but slower than they expected, 10% instead of the 15% they'd modeled. Not a disaster, but below par for them.
Okay, so what did they do?
They didn't wait around. Swift countermeasures, complete change in leadership for ProCare, big improvements to how they sold the product, big focus on customer support.
So the lesson there, for anyone listening, is pretty clear. Don't wait when things aren't working. Act fast.
That's exactly it. And they say they've applied that learning directly to newer deals like Transact, Central Reach, and now Subsplash. Those integrations have apparently been much smoother. They have a tighter schedule, quicker actions. It's about getting that initial execution, the intercept, as they call it, right from day one. Even if the market itself, the slope looks good. Learn and adapt.
That makes sense. Learning from experience. So looking forward now, Roper seems pretty bullish, right? They've raised their outlook.
They have. They bumped up the full-year revenue growth forecast to around 13%, and the adjusted EPS guidance is now $19.90 to $20.05 for the year. That signals real confidence.
And they've got the resources to keep moving. Mentioned something like over $5 billion in M&A firepower, plus a big pipeline of potential deals.
Yeah, plenty of dry powder. And it all feeds into their core model, what they call the strategic compounding flywheel. It's quite unique. Think of it this way. They run these niche, market-leading businesses, letting them operate fairly independently, really focusing on customer intimacy, driving organic growth.
Decentralized operation.
Right. But then centrally, they have this very disciplined process for taking the cash those businesses generate and deploying it, finding and buying the next great niche leader. It's this cycle. Operate well, generate cash, buy the next great business, optimize it, generate more cash. It lets them compound cash flow in the mid-teens % range, basically doubling their cash flow every 5 years or so.
A compounding machine.
Pretty much. Highly disciplined, very focused. It's how they deliver those consistent results.
Okay, so that brings us towards the end of this deep dive on Roper's Q2. We've covered a lot, strong financials, that really interesting AI strategy for both efficiency and innovation, the Subsplash deal, and importantly, how they learn from challenges.
Yeah, it really comes down to that disciplined capital deployment, focusing on those mission-critical vertical software niches and creating that compounding effect. It's a powerful model that lets them keep exceeding expectations.
So here's a final thought for you to chew on. As we see more companies using AI like Roper does for internal games and new products, how might that change the game? Especially the balance between hitting short-term profit targets and making those longer-term strategic investments. Roper seems to lean towards reinvesting those AI gains for future growth. Is that the winning model going forward? Something to think about. Thanks for joining us on this deep dive.